before I shoot the questions, I will, let me put the current situation in perspective. Feroze, you spoke about wealth creation, wealth protection, and if I may call wealth distribution, the last of it. But I will focus on wealth protection in the current market scenario. Today we have far too many moving parts. Some of your colleagues would also know the dollar has been rising, US bond yields have been rising, and the US equity markets are going through one of the longest, perhaps the longest bull run that we are seeing. Now this has, the combination of all these three has inflicted serious injury to many emerging markets, and India has not been spared. Now in a situation like this, millions of investors have seen their wealth getting eroded. It could be any asset class for that matter. I'm referring to this in the context of India. Now in such a situation, protecting the wealth is paramount. How would you respond, and what are you telling your clients?
Correct. I think you've really summarized what's happening today. I think the only thing you can do is expect a return. Like whenever you see these finance books and open them, return is always prefixed with a word called expected. And risk is always suffixed with a word called management. The only thing you can do in the business of money management is risk management.
Right.
Expectation of return is what you could do, because return is going to be determined by several factors. Risk is in the room. It's your baby, it's your decision. So risk management becomes the most important aspect when you claim that you're going to manage your money or somebody else's money. Now, if risk is the primary driver which you are wanting to keep under check, you will have to understand risk in its entirety. Now that we are on the topic,
right,
then I'll come to the answer of the contemporary situation of how do we try and address that. Risk, unfortunately, in the world of wealth management has been an English nomenclature. But in treasury management, it is mathematics. Risk, people say I'm aggressive, moderate, conservative, right? But actually risk is measurable. Risk in statistics can be very efficiently measured by 5 different variables. What am I saying is, before you manage anything, you have to measure it, you have to understand it, and then manage it. So risk is measurable. One of the most prominent methods used, 99% of treasury managers will give immense weightage to something called, might sound technical but it's very simple, so not to intimidate you with the technical jargon, it is called standard deviation. If you think risk is important, you will have to spend some time to understand this concept called standard deviation. It tells you the deviation from your expected outcome. If I'm expecting 15, what is the deviation I might see? It gives you a sense of the deviation. Lower the standard deviation, the tighter the range you will be ending up making. See, in a fixed deposit, if you have been promised 8%, you will make 8%, no more, no less. So standard deviation there is 0. Expectation will match reality. But equity, unfortunately, is not the case. Real estate, which are the 2 large assets, does not have that case. If I'm expecting 15, I might get 20, I might get 10. I might also get minus 10 or 30. So smaller the standard deviation, smaller is this range. So first step is measure your standard deviation. Nifty standard deviation. Now if I marry it with something, the largest index of India, the largest benchmark of India is Nifty. The standard deviation of that index for the last 3 years is 13. Why am I giving this number to you? So that you have a benchmark. If your standard deviation is 20, that means you've not done risk management. If your standard deviation is 8, then you're done okay, because 13 is Nifty standard deviation and you're 8. So now coming to what do we tell our clients? You have to create a portfolio which can give you a 15% return, but you should never exceed 8 standard deviation. That's how That's how we position our portfolio. How do you do that? There is one instrument which comes very handy to do this, is called a LEAP. L-E-A-P-S. This is a very important thing for anybody who has even a rupee invested in equity markets, not just in India, anywhere. It is called LEAPs. It is nothing but a portfolio insurance. Just like I can insure my life, I can insure my cars, I can insure my factory, how I wish I had any. But yeah, if I had one, if I want to insure it, then similarly you can insure a portfolio using a LEAP. If Nifty comes down to zero, if the market comes down to zero, if you have bought the LEAP on NSE, National Stock Exchange of India, NSE gives you a compensation for the fall. Just like if you have bought car insurance, you go crash it, the insurance company makes good a large portion of the loss. So LEAPs are a very, very important part of wealth management, not used enough by individuals. That is what we have been recommending from 1st of January this year.
Right. Let me. This is a very interesting product. This is something which is very important for all investors, not just HNIs. See, last year, Nifty was around 11,000 less. We had enough money coming into the country. We had money coming into debt. Now, everything is flowing back. In a situation like this, we have had 7 to 8 weeks of steep correction in the Nifty. We have seen 14 to 15% fall in Nifty, both time and price correction, as they would say in technical language. Basically, there is a 14 to 15% erosion in Nifty. How will LEAPs help in such a situation, if, assuming that somebody has taken the product?
If somebody has used LEAPs, let's assume a 3-year LEAP, will cost you 1.5% a year. It is not a very expensive affair also. Today the market lost 1%. Right. I couldn't do much. I just had to wait and watch.
Sure.
If at 11,500, when the Nifty was right up there, if I had the courage to spend 2% a year, then that 11,500 gets locked in. By which I mean, if the Nifty came to 10,000 and remained here till the end of the period, NSE will give me 1,500 rupees. I will be restored back to 11,500.
Right. Okay.
That's what it actually means.
This is something which a fund manager is supposed to do. They will hedge against various risks and make sure that you don't lose much. In a market like this, where all classes of assets, whether you take currency, whether you take equities, whether you take debt, of all the 3 debt mutual funds, I'll come to that in a bit, there is a general perception that debt mutual funds are safe. The risks there are limited. But I guess the risks in a debt market is far more complicated. How do you help and advise your clients and investors and tell them that, look, debt is not absolutely safe, it could be a certain portion? How would you?
Correct. I think when it comes to debt is, so for the benefit of understanding, debt is when I lend to a company, equity is when I become their partner. If I became their partner, then the risk is more. If I've lent to them, I am supposed to get back the interest. But if the company goes bankrupt, then the money doesn't come back to me. So that is what has happened in India over the last 1.5 months largely. On 3rd September, one of the strong companies called ILFS was brought down from a very strong company, AAA, 16 steps down, and said it has gone default. So when this kind of carnage happens, people's confidence, even in debt, has got shaken up. Yeah. So the solution for that is, which we have been saying for the last 5 years, that don't rely on ratings. Okay, ratings have had a very bad track record because we analyzed 20 companies which went bankrupt. And we saw 14 out of those 20 companies were rated AAA. 1.5 years before they went bankrupt. If 14 places which went bankrupt were called the best, strongest companies just a year and a half back, how can I take my decisions on lending to a company on the basis of rating? So there is another concept which helps you measure risk when you lend to a company. Anytime you buy a debt fund, or a company's bond. If you lend to a bank, you lend to a corporate, or you buy a bond which is AAA rated, always measure another thing which a treasury guy will surely measure. It's called Z score. It is called Z score of the company. Of course, sounds very technical, but as a wealth management outfit, I produce those Z scores. So my clients don't have to go through the painful process of computing it.
Right.
What is a Z score? It tells you whether the company is strong or not. As against just the ratings, you should also see Z score. If I give you an example, the last large default in India was of a company called Amtech Auto. It was called AA for 4 consecutive years. One day overnight it became default. Altman Z Score, that's what it's called, Altman Z Score, was anything greater than 2.5 is good in Z Score. The company was 2.8, 1.24, 0.34, minus 1.24. So Altman Z Score told the story clearly that this company is financially becoming weaker and weaker, and if I use this as my judgment input, not ratings, I might have reacted sooner. So on the debt side, we tell our clients that you just can't look at ratings. You have to look at the debt fund's Z score and then make a choice of making an investment so that you are ahead of the curve rather than behind.
Because, see, we all talk about long-term investments. Now, long-term investments could be 5 years, 10 years, 15 years, 20 years, sometimes even 25, 30 years, depending on the age group. And so long-term is basically as long as you want to stay invested. Let me put it that way. For somebody who's, say, got a 5-year time horizon, how will you mix debt and equity? Because the risks have to be managed. We will talk about risk and expectations management in a bit. In India today, we are looking at 7%, 8%, 9%, going up to 14% depending on the risk and the lending. Your inflation rate is roughly about 5% as you pointed out. Let's take it as 5%, though the target rate is different for the RBI. You pointed out about the 12% inflation rate. Now, achieving 15% in a market like this is going to be challenging. What kind of products will you offer to people and make sure that over a longer term it's balanced, and for somebody who's got a 5-year horizon?
So there are 3 things before you form a portfolio. One is asset allocation.
Yes.
How much in different assets? So there are only 4 assets. Everything else is a distraction. If your objective is simple, to make 15% is not a very complex objective. So your answers have to be simple. If somebody said my aspiration is to make 23, then the outcomes or solutions will be complex. If the problem is simple, the solution has to be simple. There are 4 assets, 2 growth assets. Equity and real estate are the 2 assets which have the capability, not always delivered, capability to beat the 12%. Gold and deposits are the conservative assets, and equity and real estate are the growth assets. Currently, as we speak, we don't think real estate, for the last 4-5 years we've been negative and we've been very vocal about it. At least we think that Indian real estate will go through a large correction. I don't hear something very different about Dubai real estate either currently. So the point I'm trying to make is where our domain is, real estate should be practically zero if you could make it in India from an investment standpoint. If you want to have a home where you would go back someday and use it as a holiday home or as your retirement home, that is not counted. Real estate should be zero. 65% should be in equity. 35% should be in debt. That's the asset allocation we recommend. I think this, if you test it over 30-year periods, we have tested it over 30-year periods and found out what is the expected return, what is the deviation. So step 1, asset allocation 65-35. After that, there are several products you can choose. There are at least 11 types of products in India and there are more in Dubai because it's a far more open economy from a financial services perspective. Out of these 11 products, we at Anand Rathi 6 years back banned almost 7 of them because they were destroying value. If you check their data, these 7-8 products were destroying value rather than creating. So we create portfolios with only 3 instruments: mutual funds, structure products, and a certain extent of leaps to manage risk. Anything else can be statistically proved that it is only experimenting with your money, and data clearly says that you will have lesser odds to win than
Absolutely.
win.
Absolutely.
So this is the goal.
You have excellent products in the market. There are hundreds of thousands of mutual fund schemes in India, and today mutual funds are the most important vehicle for saving and investment, which you know very well. There are people who invest as low as 500 to 1,000 rupees and to as high as $1 million also in mutual funds. But the last 3 weeks, or rather 4 weeks, I would say, from the peak, there are different products that are offered to investors. A combination of small cap funds, a combination of mid cap funds, large cap funds, and now we have multi cap funds. Now of this lot, and there are also thematic funds and sectoral funds. The worst performing fund group, let me just go back to this one, is the infrastructure funds. They were down as much as 42% from the recent peaks. Okay, followed by small cap funds, they were down about 36% from the recent peak that they had achieved. Tax saving funds, which may not be relevant to our audience here, they were also down by 35%, though they are closed-ended funds. Then let me also look at a couple of other funds. There are contra funds. Unfortunately, even contra funds failed. Contra funds are supposed to make money or at least protect your wealth whenever there is mayhem in the markets. They were down by 32%. The only ones that have saved and not really bled much are the large cap funds. They have lost about 14 to 15%. Now, in a market like this, is it advisable? Large cap funds generally mirror the Nifty and index. In a market like this, for somebody who is investing over a longer period, let's say 10 years, would it be advisable to simply go into, let's say, a Nifty fund, a passive Nifty fund, which simply at any point in time it gets the best of the companies into the index? So I don't have to worry, you don't have to worry. Do you also offer those kind of funds? Sorry, my question was slightly long. I wanted to put things in perspective and raise this issue.
No, I think it's a very important issue, and we have to let math do the talking.
Okay.
And if you analyze math, so point one which you made, which is saying mid-cap funds, small-cap funds, infrastructure funds have fallen substantially.
Yes.
They have. That is largely a problem for a person who looks at the rear view mirror and invests.
Right.
2017, exactly these same funds had made 60%. So what happens is, especially retail audience sees 60% return and gets very attracted. 2017. Fortunately for us, every 1st of January I do a show, of course with your competitor, BTVI team, where we record our recommendations of what you should be doing. So that there is, for a calendar year, you record your recommendation. It was crystal clear. If you don't look at rear view mirror, it was crystal clear that mid cap and small cap funds had gone far ahead. See, market has this habit of exaggerating everything. If things are good, it will exaggerate it even further.
Absolutely.
If things are bad, it will exaggerate further. So mid caps had done no great performance for their prices to go up substantially. So point one is, don't look at the rear view mirror and invest. If I don't see the past performance, then what else do I see is the next obvious question anybody asks us, right? So don't look at the rear view, then what do I see? So if finance has an answer. Finance has a subject which is called statistical astrology. It tries to predict the future, better predict, not perfectly, which is called regression. So we try and use regression to choose those MF schemes. So we chose 9 schemes. Those 9 schemes are down,
Right.
but at an aggregate of 7.5%. So when there is carnage, if I don't lose as much, When it goes up, I gain little more than the market, I will be better off. So point one from the question which you asked, which was very important, saying that this kind of fall, how do I save? Try and not get lured by the past performance, because one clear thing which comes out of 30 years of analysis is that whenever something runs significantly more than its peers, he will stop and take a breath or come back. That is called mean reversion. Mean reversion. Okay, so when you see mean reversion apparent, this is exactly what happened in July 2013, July-August. So first 8 months of 2013 are an exact replica of 2018. Now, people would drop their hats and say these mid-cap and small-cap funds are a carnage. Let me not get into it. But if a person so concluded in 2013, then 2014 actually gave 20% better than Nifty. So, rear view mirror, even if it is very exciting, it is scary to invest. And if it is very doom and gloom, may not be the right time to sell, may be a good opportunity to buy. So, we use regression, and regression better predicts, not perfectly for sure, but past performance is a very bad indicator of the future. Point two, which was, sorry.
On the Nifty index, why not just simply say that let me buy Nifty index, whether it's a passive fund or an active fund. I would rather suggest passive fund because the costs are much lower there, as you know. Do you think it's a good idea to simply say that, look, I will buy the Nifty or the Sensex for that matter, where I get 30 stocks, they are the best based on their market capitalization, they get into the index.
Correct.
And just not look at it for the next 10 years or 15 years. If I'm looking at that kind of a horizon, would you include those kind of products in your structured products?
Why not? Why pay such a fee to a man to create more than Nifty when I can just buy the best 50 companies at a lower cost? That is called passive management. There is active management, there is passive management. In passive management, the fund manager has to do nothing. He has to just buy the 50 companies, so the cost is almost halved. But if you look at data, India is still 20 years behind, 30 years behind than developed countries. In the US, 80% of mutual fund investments are passive. They just try and replicate something. Nobody tries to use their intellect to create value for you. India is far, far behind. So there is so much scope for a good fund manager to create more return than Nifty. And it should last for the next 8-10 years at least. So in India, you should definitely, in an inefficient market, look at beating Nifty and not try and save the 1% cost, at least for the next 7-8 years. Now if I put a number, if you would have invested in Nifty 25 years back, your 1 crore or 100 rupees would have become 900. If you gave it to all the fund managers available at that point in time, only 10 of them were there, your 100 rupees in Nifty became 900. Your 100 rupees in those 10 funds has become 2700. So these fund managers used their intellect and created value. I think we still have more value to extract out of inefficiency. I think 7-8 years from now, you're absolutely right, we will have to just save the cost. Because this 2% cost you pay, if I have to be honest with you, 1% comes back to me as an advisor. 1% the fund manager keeps. Okay? But I personally think to save this 1%, you will lose 3-4% when you try and save this 1% for the next 7-8 years.
Absolutely. Let me now come to the difficult part of the question. This is something which it's not just for investors, it's also for fund managers. It's very easy to buy, but difficult to sell. You don't know when to sell. If you again look at, let's say, long-term planning, 5, 10, 15, 20, if I can put it that way. People have goals for 5 years, 10 years, 15 years, 20 years, whatever might be the objective of wealth creation. Now, again, going back to the Indian example, of the market. At the peak, it's fashionable to say that, don't time the market. But then if you don't time the market, either you miss the bus or you miss the opportunity to sell. Now, selling is very difficult. Prices always rise after you sell and they fall after you buy. how do you help investors understand this? Because you would have advised, let's say, 10 years back, long-term planning, the correct timing of selling and making sure that your wealth, you realize your wealth and move to safer.
Correct. So one is to sell. So of course it's very tough to sell. When the market is at the peak, there is everybody who's going to tell you that it will further go up. And unfortunately, when you see television, so many experts, when the markets fall, they will extrapolate it and say it will further fall.
Yeah.
Right? So they
On either.
both sides. If that's the case, what you should ideally do, what a corporate does, is that there is one corporate I try and manage as a close client for the last 10 years. Every 31st March, whatever is the level, he says, hedge me here.
Okay.
I don't want to dip into my profits of the last year. Right? If you don't do that, if you don't up your ante, if not every year, for an individual investor, every 3 years, whatever you have made, you have to make sure that you've pocketed this and you don't go back in time. So market has this attribute of giving you supernormal returns, like 2017 was 28% return. 2018 is negative. So every time after 3 years, you have to repeg yourself and make sure that becomes your next level. So if you're not doing that, then you should sell as you come closer to your objective. But I think finance has a solution which is so simple that to hedge, like I said, you pay a cost, 1.5%. There is another method which we productized so that a person can in a simple fashion understand. If I want to lock in my level, if I don't want to pay a penny today, I can also commit a profit of the future. So today, if I said I want to lock in the current level, I don't mind giving away some profits of the future to insure myself. 85% of the profits I can keep. If I gave away 15% of the profits, which is not a very large quantum, I can protect myself. So point is, if you don't know when to sell, because it's very tough, I completely agree with you, right? Otherwise, we should have all sold, right?
Yeah.
When the price to earnings tell you that the market is overvalued, you will sell, but it's not going to be so easy emotionally to sell. So you hedge. If you don't want to pay a price for it, just pay a potential profit to the extent of 15% is what we suggest.
Absolutely. In fact, in our conversations on the channel, every time the markets go up by 10, 12, 15%, this is one standard question we ask all our experts, whether mutual fund managers or equity research experts. Is this overvalued? This is a question we keep asking. Before I throw the Q&A session, throw the audience open to Q&A session, there are a couple of other important questions we need to address. One is the taxation part. Now it's become far more complicated. At least back home in India, most fund managers say that don't take the dividend option as far as mutual funds are concerned. They suggest systematic withdrawal plan to save on the dividend tax. And the long-term capital gains tax is something you can't escape. Here, of course, it's a different situation. How would you advise from a taxation point of view for investors, especially looking at Indian assets?
Correct. So this group who has money in India or has a possibility of having assets in India, I think is the luckiest group sitting in Dubai. Okay, why I'll tell you that? Because if you look at how movable property is taxed for a Dubai resident back in India is very attractive. I'm not going to go into the details because in a show like this, which you're going to telecast, I would want to be a little more cautious. But I think you should understand why am I calling this group the luckiest. Because a few years back, my brother moved here to Dubai. And the investments which he would do in India into immovable assets is taxed at negligible or nil. If you qualify in that category, and most of us in this room, most of you in this room will. So understanding what that is. So if I as an Indian resident, which I am, if I'm taxed 30% on maybe a derivative transaction or a short-term capital gain, taxation for you for the same asset is very different and in most likely situations negligible. is what I would say. But of course, tax is a very specific item or to that individual. That is why we always submit to our clients to get a strategy meeting done. Of course, I am digressing from the conversation a little. So we always request our clients to spend 3 hours, 2 hours in a closed room to discuss the strategy for that specific individual. If they like it, then they execute the strategy. If they don't, they don't. But understanding the strategy, which is the individual's private strategy, will actually answer the taxation on a more specific area rather than a general comment like I just made.
You explained estate planning and handing over your wealth to your loved ones. What about the tax angle there? Will they be liable for taxes? Should that part of the planning also be done in advance?
Correct. I think it should be done in advance. One is when you give your money to somebody else, which is bound to happen at a point in time. There are two vehicles which are popular to transmit this money. One is a will. Will comes into existence the day I die. Till that time, that will is inactive. But there is another more efficient method, in our opinion, debatably of course, is a simple investment trust. Simple, irrevocable investment trust, which is a far more efficient method. The day I am not there, the next day, the next karta, whom I have nominated as the custodian of this wealth, will become the signing authority within the next 24 hours. So I have seen people struggling for 10-15 years to get the money into their nominated accounts. There are two methods to summarize: will and a simple investment family trust, which is more relevant to this group because it becomes an Indian entity. If it is registered under the 1964 Trust Act in India, it becomes an Indian entity which gives you a larger flexibility to invest in India, and it also serves a very strong purpose of estate planning. That's called an irrevocable, simple, because trust can be as complex as they want to be. So I made a trust for myself. So 60% of my money is in the trust. So as I progress in life, I would want to have 80-90% of my money transmitted through this trust and 10% through my will, because I don't know which day I will die, because that's why a 10% will be here. Then this 90% is transmitted as efficiently as it could be with negligible losses of time.
The other relevant question, of late this keeps coming up whenever we do the show, is people who are in their 30s, they are setting up their family. They tend to invest in their children's name, over a period of time to possibly take care of this, and also do a joint account. Are there any issues there, or do you think that that's an easier solution to this?
Yeah, when it comes to children, there are 2-3 things. Joint accounts. People like to believe that if I have a joint account with my wife, the day I'm not there, she will be the sole owner, or vice versa. But actually, the rules are different for different banks in India. Okay, and you'll be surprised because Indian estate planning is not governed by the entire central law. It is governed by states. So the rules are very different. If I have a bank locker joint for a bank based out of Bangalore, like a Vijaya Bank is headquartered there, is very different for Kotak. That's exactly why I was alluding to the nitty-gritty of estate planning is very important. Actually, if you have a bank account and if I have made my wife the nominee 50-50, we are joint holders of 50-50, the day I am no more, she does not become 100% owner. She only becomes 75% owner. Her 50 and 50 of mine. The other 25 gets transmitted as per my will. So there is enough complexity for you to actually get this done by somebody who is doing it for a job as a professional.
So making complicated uncomplicated, and from our channel's point of view, we always try to help viewers save, invest, and prosper. With that, I will thank you, Feroze, for this brilliant presentation that you made, and I'll throw open the session to question and answer.
Can you give me some examples of ring-fenced assets, which you said? That's one. And second, you said about the Z Score, the Altman Z Score.
Z Score.
Can you use it for banking and NBFCs, or is it reserved only for the non-banking company? So these are my two questions. Thank you.
Very relevant questions. One is, of course, ring-fenced assets in India can be done by three methods. One is PF, an employee provident fund, are ring-fenced. But there is talk to remove the ring fence, by which I mean if there is some financial liability on me, the provident fund and the employee provident fund is not attachable. All my insurance policies can get attached, my mutual fund can get attached, my bank account can get attached, my real estate can get attached, but the PF and EPF is ring-fenced. That's method one. But unfortunately, the money is so small generally that it will not suffice for my lifestyle or my dependent's lifestyle. So there's another method which is called Married Woman Property Act. Every insurance policy which you buy, you can actually opt to buy that insurance policy under the Married Woman Property Act. If you so did it, then that specific insurance policy becomes unattachable. But unfortunately, we can't use Married Woman Property Act. We should not use. We can, of course, because we analyzed 2,000 insurance policies which were held for 10 years and the return was 4.6%. 8 years back, when we realized that it was such a disastrous investment, in spite of, it gives me 60% commission. If I took a crore rupee check, I get back 50-60 lakhs. Right? Then you start with your 50 lakhs and then grow on. So we banned insurance policies. So Married Women Property Act is a good method, but unfortunately, I'm compelled to buy an insurance policy where I'm using my money suboptimally. So the third offshoot is again an irrevocable private trust. If it is irrevocable, it becomes ring-fenced. So when it also serves the purpose of protecting, it also can serve the purpose of transmission. So that's called an irrevocable private trust. That is exactly what happens when you buy an insurance policy under MWPA. It is abbreviated as Married Woman Property Act, is abbreviated as MWPA. If you bought an insurance policy in that, the insurer goes and creates a trust on your behalf. If I told him to create the trust, he compels me to buy insurance. If I create the trust, then I can buy property in it, I can buy a car in it, I can buy equities in it, debt funds, whatever you wish to buy. So you create your trust and make your confidant as your second trustee. And you are still the karta of that trust. So these are the three methods. Then second question, which is very, very pertinent, I'm sure that's a very good question. Can you use Z Score or Z Score? Altman was a person who introduced this, and it is one of the strongest methods to check the company's credentials to pay back your money. Is largely used for manufacturing companies. With a certain alteration and a different target, it can be used for financial services.
I have two questions, one on the Z Score again. If it is established or it is an indicator, why people are not using it, or why institutions are not using it as compared to the ratings? That's one. The second thing is nowadays the investors can go directly to the mutual fund house and buy mutual funds directly without spending whatever that percentage, one percentage. What is the value addition that Anand Rathi will give so that instead of going directly to the mutual fund house, we come to Anand Rathi?
Wonderful. I think both the questions are very, very apt. Unfortunately, this is a homogeneous group. So that question, I think everybody should ponder upon and then come to a conclusion whether you need an intermediary or you don't. So for people who don't know, I'll describe the direct method and then I'll take your Altman Z Score, because I think the second question is very important for the entire group. There is, in 2013, Security Exchange Board of India said that every mutual fund, you can invest through a person who chose it for you, through a wealth manager, or you can skip the wealth manager and directly go to the mutual fund as well. And if you so did, skip the intermediary, your cost will come down by 0.75, 0.5, to a certain extent 1% also. Now, the question which sir is asking is saying that why should I go through you if the mutual fund is directly available to me? Now, if there are close to 436 funds, it is very important to understand which are the 7 funds. If you look at history, every year the best and the worst fund has a 25% difference in performance. Like sir read out,
Absolutely.
there were funds which have lost 42%. There are funds which are up 1%. In such a diverse environment of performance, I would ideally put all my effort to identify the right fund at the right time. Will Anand Rathi be able to do it is the next part of the question. So I would want to go in search of that person who's going to spend all the technical capability to identify me the most contemporary fund, so that I don't try and save this 1% and lose 5 somewhere. So in 10 years, if you saved, let's assume 0.75% every year, you saved 7.5%. If I go wrong once doing it as an investor, or you go wrong once, the 7.5 will go away. So what we do is, I have a 22-member product team, only does mutual fund selection. So what does it do? Okay, now, and this will not be available in public domain, unfortunately, and I wish that I can put that in public domain. For example, there are 142 people, fund managers, who are all claiming that we will do a good job to manage your money. I have to choose 5, 6 out of these 142. Now what we do is, we go and check all these 142 people last 100 decisions. See, their job is to take a decision, buy and sell. So we check 100 decisions of each of these 142 people. That makes it 14,200 decisions. How many decisions did he go right? How many decisions did he go wrong? So that is called the right to wrong ratio of a person. If I am good, if I claim I am good, I should at least take 80 right decisions and 20 wrong. If I am taking 50 right, 50 wrong, or 55 right, 45 wrong, law of probability, I can either go right or wrong. So only 21 fund managers out of these 142 have a good right to wrong ratio greater than 75. So that becomes your primary driver. Then you see which are the schemes these 21 guys are managing, because the rest of them don't deserve to carry a fund manager tag. So this is one illustration of the 7 things we do before we come and tell you what scheme you should buy. Now people say the proof of the pudding is in the eating. So we say that you can fortunately check the recommendation 6 years back which Anand Rathi gave. On Google it will be available, because you would have done some media interaction. If you see those schemes, would they be the best schemes, all of them? The answer is a big no. Would they be significantly better than the average schemes? If you bought, significantly better, right? So we try and see that we add that 75 paisa value, so that I can well deserve that money, and the day I realize that I don't deserve that money from you, I would say go into passive or go direct, and take a smaller fee from you.
Absolutely.
But that has been added as well.
No, before you answer the second question, I just want to add to what he said. Take for example small cap funds. There are many small cap funds. Recently I went into some portfolios of 3 or 4 small cap funds and found that one small cap fund had only 40 stocks. The other small cap fund had 65 stocks, and the third one had some 60, 70 stocks. Now some small cap funds did brilliantly well the last time around. They invested in companies which were looking very good. Some of those companies are now out and done. They are just not even surviving. So that is the kind of risk that is available because at the end of the day, it's a bunch of stocks that they invest in. Now how they pick those stocks, What do they visualize? That's a bit of a challenge. Unless you yourself do the research and you are convinced, going directly might be a little tough.
Correct. I think because if you think, now comes whether Anand Rathi can do that for you efficiently. If you look at data, we'll say that, yeah, we have done a fair job. I don't want to claim that we've done a great job. But if you think Anand Rathi doesn't do a good job, we have to go look for a person who can justify it, rather than still don't go direct. Go find that person who can justify this 0.75. And if the difference is so large, that performance in the same category, now let's go, same fund house, okay, SBI mid cap, SBI focused equity. Same fund house, fourth largest fund house. So you would say, it is the fourth largest out of the 42 companies. How wrong can I go? SBI mid cap, we gave an exit about 2 years back. Okay, we, in the sense, my product team gave that exit. And they said move to SBI focused equity, which is a Vasan, there's a guy called Vasan who manages it. Has 28 stocks in the portfolio now. Okay, there is a difference of 17-18% between the same fund house. That was a larger scheme, this was a smaller scheme. If you optically bought it, you will say SBI mid cap is an older scheme, larger scheme, let me buy that. So there is such dispersion that you will be able to find value. So there is, and I'm telling you only one item for the lack of time out of the 6. So it's a very, very important question because every one of us can actually save that 75 paisa if you cut the wealth manager. But should you be cost sensitive or value sensitive is the choice you have to make. And I should say you should be value sensitive than cost sensitive in a divergent market.
I have 2 questions. So one is about real estate. I think most NRIs have invested in real estate in India. And at this point of time, you also referred to it, you said the last 3 years, in the next 5-6 years, whatever, is going to be a depressed real estate scenario. Now, for an NRI who's got assets locked in real estate in India, it's a situation where you can't sell because it's a depressed market. The rental returns you make are very meager. Are there any strategies by which you can improve your returns on real estate without having to sell them in a depressed market? That's my first question, and maybe you can come back to the second.
Yeah, so sir's question is, what do I do if I can't sell it? Can I hold it and improve the efficiency of the instrument which I've held? Firstly, in a high interest rate economy, you can't do that so easily. Why? Because, see, one is you sell it, one is you rent it. Okay, you can do renting, and then you can borrow against it and invest to get some fillip. But if you are speaking of a high interest rate economy like India, if your borrowing costs are 9.5, 10, the risks you will have to take to generate more than that, because that's the only method I know, because somebody else might know some other method, that you can create efficiency on a locked in asset, which I can't do. Like an insurance policy, I was analyzing, and somebody had invested a few crores in an insurance policy which was locked in for 10 years. So you know that it's going to make only 5%, can you remove it? But there was a possibility that he could borrow because he was getting a tax break. If you were having a business establishment in India, then I would have recommended borrow at 9.5. You will save 35% tax, so your borrowing cost comes at 6. Right? You will have investments which you can definitely make 10, 11 without too much risk. Then you're getting 5 more percent, you're getting 2% rental yield, if thereabouts, 2.5. Then you have 7.5 more. Then you have capital depreciation or appreciation, whatever it pans out. And over 5 years, this 7.5 can create a fillip. So if you don't have a business establishment, borrowing at 9.5% and generating return more than 9.5 will be more risk, because you have a fixed cost and a variable return, is why I would say no. But is there a strategy to get rid of these assets? We tried to devise a strategy and it worked in certain cases, if not all. If there are 10 properties to sell, there is still one buyer for sure, for every 10 properties to sell. And what we did was we fixed price with brokers, and I sold some of my apartments in Bangalore on this basis. So I fixed a price with the broker saying that this is my price, 5%, 10% lesser than market, no problem. Anything more than that is yours to keep. So then the broker knows that the other competitor who is wanting to sell with me is haggling for the brokerage of 1-2%, But then I show generosity and say that I will give you anything beyond that. So the broker takes the client first to me, my apartment, to see where it is sold. And then I ended up selling them at a price frozen. So if you become more generous on the brokerage side, then deals have happened. At least several of our clients have sold from.